How do you actually start investing as a complete beginner? If you've ever asked yourself that question, then this video is for you. I'm going to be walking you through the absolute basics of investing step by step, so by the end of this video, you'll know exactly what to do to get started in 2026. Hey, my name is Ray. I'm a 29-year-old from Sydney, Australia, and I grew my net worth from around $5,000 when I first moved out of home at the age of 18 to around $500,000 today. And no, I didn't do anything crazy. I didn't day trade, I didn't gamble, and I didn't come from money. What I did was keeping investing simple and boring. And that's exactly what I'm going to be showing you today. Let's start with the absolute basics. Investing simply means using your money to buy assets. Assets are things that grow or produce income over time. Examples of assets include things like stocks, ETFs, which I'll explain more later, gold, and property. On the flip side, liabilities are things that lose value over time or cost you money. They include things like cars, personal loans, or credit cards. The goal of investing is super simple. Turn today's money into more money in the future. Step 1, and this is super important, is to build a safety net. Before you invest a single dollar, this is a non-negotiable rule in my opinion. You need a safety net. I personally recommend you save between 3 to 6 months of living expenses in your safety net in a high yield savings account. Why, you might ask? Because life happens. You could lose your job, you could have a random emergency bill that pops up, and your car could also break down. So for example, if your monthly expenses are $5,000, then I would save between $15,000 to $30,000 in a high yield savings account. A transaction account usually pays 0% interest, which really sucks compared to a high yield savings account, which pays you around 3 to 5% in today's current market. So for example, if you had $10,000 saved, at 5% per year, that's $500 at the end of the year into your bank account. In a transaction account, you'd basically be earning $0. Same amount of money saved in your account, but totally different outcomes. This is why step 1 is super important, making sure you have a high yield savings account and that you have at least 3 to 6 months of your expenses covered. Step 2, what are stocks? Once your safety net is sorted, it's time to understand stocks. A stock is simply a piece of a company. If you buy a share of Tesla, you own one tiny slice of that business. There are generally 2 ways that stocks make you money. Number 1 is the price growth. So if you buy a Tesla stock at $450 and they grow to $500 in the future, and you decide to sell that $500 stock of Tesla, you've just made yourself $50 before taxes. Number 2 is dividends. Some companies pay investors or shareholders money just for holding their stock. A classic example of this is Coca-Cola. So for example, if Coca-Cola pays you $2 per year per share that you own, and you owned 100 shares, that means that they would pay you $200 at the end of the year. If you owned 1,000 stocks, then they would pay you $2,000 at the end of the year. And this is how you can make money off of dividends. Now here's where investing gets super beginner friendly, and it's through a thing called ETFs, or exchange traded funds. An ETF is a basket of companies that are bundled into one investment. One of the most famous examples is the S&P 500, which tracks the top 500 companies in the US. One good example of an ETF that tracks this index is called VOO. VOO is Vanguard's own fund that tracks the S&P 500 index, and this is where if you buy into VOO, you're automatically buying into 500 of the top performing stocks in the US. There's no stock picking, there's no guesswork, there's no extra time needed to do these extra research. If some companies perform poorly, then they get replaced by the fund, which is great because you're automatically investing in the top 500 companies all the time. This is why ETFs are great, because they're super low risk and super low maintenance. Basically the golden standard for investor beginners like you and I. Historically, the S&P 500 has returned on average around 10% per year, which is a lot higher than the 3 to 5% that you get from high yield savings accounts. But the thing is, the returns are usually not guaranteed. Some years are lower, some years are higher, but on average, you're getting at least around 10%, which is still amazing. And the key is time in the market, not timing the market. This is where compounding comes in. Compounding means earning returns on your returns. So for example, you invest $10,000 and that grows to $11,000. Next year, you earn returns on your $11,000 invested instead of the initial $10,000 before. Over time, this snowballs. Early years feel a bit slow, but the later you get, the faster it will grow. This is why starting early matters more than starting big. Dollar cost averaging. Instead of trying to guess the best time to invest, use dollar cost averaging instead. This simply means investing on a regular basis, such as weekly, fortnightly, or monthly. This removes emotion and decision making. Markets always tend to go up over time, and consistency beats perfection. So how do you actually get started with investing? To invest, you just need to open a brokerage account. In the United States, it would be companies like Charles Schwab, Fidelity, or Robinhood. In the United Kingdom, it might be platforms such as eToro or Trading 212. In Australia, I personally use a platform called Stake. Stake has extremely low fees at around $3 per trade, which is a lot cheaper compared to some banks out there that are charging you $10 to $20 per trade. Once your account is open, all you need to do is deposit some money into your account, search for stocks or ETFs that you'd like to buy into. Some ETFs that I personally invest include IVV, which tracks the S&P 500, NDQ, which tracks the Nasdaq 100, which is higher risk but also higher growth potential, VAS, which tracks the top 300 companies in Australia, and VGS, which tracks the global developed countries' top performing stocks. You don't need all of these, but these are just some examples that I have invested my own money into. So here are the key things to remember. Number 1 is to build a safety net. Number 2 is invest consistently. Number 3 is to never panic when the market dips. And number 4 is to remember that the less you touch your investments, the more time it has to compound and grow over time. And in the later years, it'll grow faster and faster. So the best practice is to never touch your investments and just invest on a regular basis. And this is how boring investing quietly builds you wealth over time. If this video helped you, please subscribe and let me know where you're investing from. I'll be posting more videos like this in 2026, so please consider subscribing. Thanks for watching, and hopefully I'll see you in the next video.